Hey everyone, welcome back to the Capital Mindset Show. Today we're going to be going over Warner Brothers Discovery. So this is a long time in the making, and we're looking at the company from a new look as, Discovery and Warner Brothers are now together as part of that spinoff from AT&T. That's all old news to you guys, but there are some details to kind of work out. Let's first start with a price action with the company. Now, if I take you guys over to the desktop here, we can actually see, okay, well, it's sitting at $13.69. If we look at the one-year performance, it is down 46.31%. That's including when it was just Discovery, and now they have Discovery Plus and HBO Max and a bunch of other content. We'll talk about some of that here. Market cap is sitting at $33.23 billion. So on the surface, it looks okay, well, a lot cheaper than something like, let's say, and Netflix, which is, interesting part of my portfolio. You guys know, well, you guys actually seen the transition from when we talked about, for example, Joseph Carlson's view on, Netflix and how that's shifted and when we were buying Netflix. And so for now, this has been performing well, but looking at the market caps, you're like, okay, well, they're very different with Warner Bros. Discovery trading at $33 billion, Netflix trading at $106 billion. There's a lot more to look at underneath the surface there, but we'll get to all of that stuff. So the first thing that I want to do as a comparative, there is a video that I did make on Netflix kind of showing the content and how Netflix has been dominating the content ratings for a long time. And so if you guys are curious, I'll actually find this video for you guys and I'll show you. So here I did an hour-long video back in April 2022 talking about Netflix and why I was buying Netflix, or it's saying Netflix collapse and why I bought some shares, Netflix stock. So if you guys want to, you guys can go check out that video. I do break down each of the different parts of the business and how I think the business is going to be growing and managing through the storm, so to speak. And so for now, the price action has warranted something that, okay, I'm correct, but it's really too early to tell. But going back to Warner Brothers Discovery, my thoughts I've shared on live streams, et cetera, that I had a bit of a cautionary take with Warner Bros. Discovery. I at least wanted the numbers to report as to what the business really looks like. And in hindsight, that was a really good decision because after said report, we did see a lot of weakness with the company. Okay, so now that we have it together, we can look at, for example, the sales pitch of the company. This is presented in the investor presentation right here before us. And so one thing I'll kind of skim through this and try to show you guys is, okay, look, this is all the stuff they want to say that they have. They have these brands, they have these franchises, they have these international brands as well, or international TV segments. And they have, of course, the two apps that they are merging together, so HBO Max and Discovery. Yes, that they are coming together. Now, one other thing that you might have been seeing on the news, for example, is stuff about this, for example. So you probably heard that HBO Max is laying off 70 staffers, and it's just, so 70 sounds a lot less than the percentage. I believe the percentage was in the teens. Yeah, it's 14%, as you can see here, and I'll zoom in for you guys. So you can see it's about 14% of the staff. So what they're really kind of getting rid of is this reduction in overall, how do I say, typically it's content that Discovery Plus was already doing, this reality TV-esque kind of stuff. So it makes sense that the company is going to look for some cost-cutting synergies. And so some people obviously are going to lose their jobs, unfortunate as it may be. The company is going to try to become more efficient. So this is pretty normal, but some people are pointing out to this. I wouldn't say that that's the main problem that I would have with Warner Bros. Discovery, but it is interesting to know. Just wanted to touch base on that. So they do have, of course, all these different brands they're trying to show you. Okay, cool. All that's fun. Okay, so I want to go down to what's really important and one of the main risks that I'm going to be talking about and highlighting for the rest of the video, because it's a really big risk that we need to take into consideration if we're even considering this. So we do see this global product rollout. So this is like their time frame of it. We have the United States in summer 2023. So that's next year. And then we have Latin America, Europe, all that jazz. Okay, so going over to some other parts, I want to actually start by showing this slide because this is some interesting parts, or not interesting, but it's obviously what we need to pay attention to: profitability, average revenue per user, or ARPU, and scale diversification. That's just buzzwords, but ARPU is something we want to pay attention to for all these types of businesses. How much revenue are they getting per active user on their platform, or per user in general on their platform? Same goes with Disney, same goes with Netflix, all these businesses. It's a very so if anytime it's a subscription-based product, we want to look at ARPU because different jurisdictions, different geographies will have different prices. So want to pay attention to that number. We want it to be going up, of course. So Going over to this part, I don't really care too much about this, but this is the breakdown of their EBITDA, breakdown of the revenues. We can see that studios is making a less amount of their EBITDA. It kind of makes sense if we think about the operational costs that go into that, but studios do make a bigger portion of what we see in revenue. So what does that tell us immediately? Well, I might want to think, okay, that's higher revenue but lower margin business. Then the networks and DTC, direct to consumer, is going to make up the majority of their EBITDA going forward. Okay, so now if we take a look at some of these other parts, I want to show you guys some of this. This is concerning pro forma adjusted EBITDA is going down about 11%. This is, of course, due to operating expenses rising. I want to also highlight that there was a part in 2020 or 2021 where we saw cash flows for Discovery Plus rising a lot, and that was because they actually shut down a lot of their production. Okay, so that can be a little bit misleading. Bet you didn't know that, by the way, or maybe you didn't think about that, or weren't even thinking about Discovery Plus at all back then. But anyways, this is actually one of the most important slides. This is the risk that I was referring to before as being the primary risk, the primary concern for me and maybe for you if you're thinking about investing or you're currently invested in this, and this is the debt pile. So remember that thing I said with Netflix, with the market caps, etc. Well, that's a bit misleading. If we look at it from an enterprise value perspective, Warner Bros. Discovery is sitting at about $80-ish billion. We add that $33 billion. We take that net debt amount. So after removing cash, we get about $80-ish billion there. And we do see that, the debt pile is massive. The good parts is at least the vast majority, 87% is on a fixed rate. And the average cost of that debt is 4.3%. So it's pretty cheap, historically speaking. The variable rates is fine at 13%, but the debt maturity is going to be a bit more important to pay attention to. We do see that 29% matures in less than 3 years. Why is this important? Well, they have to get that cash or that debt pile down by paying it back. They have a strategy. They want to get it to getting a leverage target of about 2.5 to 3. You can see there. Now, that's all contingent on them producing enough cash flows to support that. But, with debt being so large, the risk now becomes if we enter a period where debt becomes more and more expensive and they have to roll over, well, that average debt cost is going to rise. And that's just worse because basically you're going to be reducing the total future value of all the cash flows in the future because you're going to have to be paying that more and more expensive debt. And so the company has to pay down the debt. That's the story right now. The story is, can they pay down the debt? For now, it seems like, okay, they probably can, and I'll talk about that in some further detail when we get to the actual results. But it's a huge concern, guys, especially in a rising rate environment where people are a little bit more hesitant to make these investments, right? A little bit more hesitant to lend you some capital. So you're probably, it's tough, all right? So this is the primary concern, and I'll actually show you some other parts or some images that are going to be a bit concerned. So I saved myself some time and I found some interesting images showing on the internet showing us different metrics, right? So debt to annual sales, we do see that, for example, Warner Bros. Discovery has a huge amount of debt relative to the sales produced by the business. Now, this alone shouldn't be too much of a thing to pay attention to, really, but it's just, again, highlighting how much in debt this company is relative to its competitors, someone like Netflix, someone like Warner Bros. Discovery. So the leverage is definitely high. And take a look at this other one. So this is debt to tangible assets, another image that I thought, again, it's easy to just grab it out and kind of talk about this. So we do see, again, it shows Warner Bros. Discovery is, of course, the most leveraged. Warner Music, which was once a long time ago part of the same business, but, they are separate. So we do see that they have a huge amount of leverage relative to Netflix. Now, some of the differences that you can see between Netflix and Warner Bros. Discovery is that Warner Bros. Discovery is always talking about, well, as of now, lowering that leverage, while Netflix isn't really in a position where they're kind of concerned. And in fact, they can probably take on more leverage. We do see that Walt Disney World has a bit more leverage, but they almost have about the same leverage as Warner Bros. Discovery, but the reason why this measure is not showing it as high is because Walt Disney World has a lot more tangible assets, right? They have parks and stuff. So, of course, they're going to be lower down on this specific metric. But I've talked about Disney World as also having, or Walt Disney Company as having a lot of leverage as well. And that's due to the pandemic. So that's actually a lot of permanent destruction that did occur in their business. So they're going to have to repay that over time or get back down to a better level. They actually got some really good deals. I remember back in 2020 or 2021 where they were actually selling some debt for huge maturing rates or huge maturing years into the future. It's nuts. Them, Brookfield Asset Management, and Facebook recently got some good ones. So yeah, that's some of those metrics. If we take a look at some other metrics here, we do see that the returns of Warner Bros. Discovery, again, just taking this chart, I think it's useful to kind of show a visual for you guys to see that Warner Bros. Discovery has underperformed relative to its peers. And looking at some other ones, we do have also the enterprise value to EBITDA evaluation, with Warner Bros. Discovery being one of the cheapest ones presently, but I think deservedly so. I don't like to hamper on this metric too much. It's actually still very comparable to something of the likes of Netflix, which is kind of funny. But yeah, overall, I think that it's deservedly cheap. Many of these are actually deservedly cheap, and some of them are deservedly expensive, like actual Warner's Music Group and even Spotify to some extent. Walt Disney World as well. So Walt Disney World, we have to think about it a bit differently, but yeah, because it does have some things that distinguish it from the pure stream providers. But yeah, that's just a quick comparison of the two. So let's go back over to the evaluation model. So in the evaluation model, I also wanted to kind of highlight some key points that are a bit of a concern or a red flag. So the growth rates that I'm applying are in a range of, pretty conservative to even a bit aggressive, even though it doesn't seem like it is aggressive. 12% is pretty aggressive. So they are going to be growing HBO Max and Discovery. We'll see what happens when they kind of combine it together. Maybe you think I'm being a bit too conservative on my discount or my margin of safety, but there are a lot of concerns, again, with me and this company. And you can see the prices reflected on the prices to buy on the right-hand side. And we'd have to expect anywhere from a 31% drop to a 55% drop in the worst case scenario for what I've projected here. So I'm sticking by these projections. And so what I'm basically highlighting, and if I actually change this to, kind of just lower my margin of safety, you can see that 12% growth is where we're basically at right now. I'd probably wait for lower prices, but we're getting into a good buy point or an area where I think that the price is reasonable for the risk. But I'm not super excited about this company as I was with Netflix. I don't think personally that the business quality is there. I think that the spinoff, what they did, AT&T did the right thing for their business, where they are basically, alleviating a lot of themselves onto Warner Brothers Discovery, and they're reducing the burden for themselves and just placing it on another company. And Warner Brothers Discovery is going to have to figure that out. And whether or not shareholders bear the brunt of it is, yet to be seen. That's up to you. That's your decision. And if the debt doesn't show up as a problem, then forget about this, because they could be doing much better than what I anticipate. They could be doing much better than what many people anticipate. They're gonna remain within the portfolio, and what I'm basically gonna be doing is just nibbling down. My buy prices, where I'd be accumulating a decent chunk, would be. But the thing is, here's the asterisk to what I'm saying there, and this is actually pretty important. And many of you were probably thinking this. Well, if the price is getting down to those levels, maybe something is going to be happening that's really wrong, that changes the thesis. So as long as I don't see anything fundamentally change at the present moment in time, where I'm not super concerned that they're just going to actually go BK or they're going to have to start selling off assets, then okay, I'll be fine. I want to also address the stock options for the CEO, where he's actually giving himself about $200 million. So looking a little bit deeper, the stock-based compensation, or the stock options, I believe they have a strike of about $30-ish a share. So the stock price has to appreciate substantially in order for him to actually make any form of payout. So if he performs well, the amount of ownership he currently has and the amount of compensation he presently has, which I actually looked into it, it's pretty normal for what that industry pays. So he's not really too egregious. The stock options, again, $200-ish million for about $30 a share. We basically would have to see prices above that $30 a share for him to execute on them. So otherwise, it wouldn't really make any sense. In that case, I'd probably be. I'm not concerned by that, is what I'm trying to say. I'm definitely not concerned by that. But I think that the CEO has placed himself in line with shareholders, so that part we can just put to the side. Okay, so with other things, you can see here, the model doesn't even understand if this company will go bankrupt or not. And same with the Altman Z-score, doesn't say. But I'd say the Altman Z-score is more, it's better used for industrial companies, but oftentimes they are aligning. And when I see this right now, the model's not liking me adding to this, even though I do have it in the portfolio, and I might be nibbling, not might, I will be nibbling here and there. And I'm excited to do a portfolio update. So I'm going to be doing one rather soon. I did some moves. I did actually reshuffle some positions, got rid of some smaller positions and stuff like that. And so I'll be excited to do that video for you guys. So going back to this video, again, I recommend that you guys can watch this video if you want to see a big breakdown on the industry as far as who is winning at the present moment in time, because not much has changed since April 2022 till now. And this was back then when I was buying Netflix stock, or when I was still buying Netflix stock heavy. And so far, it's turned out really well. So a lot of the pessimism that we saw around Netflix stock was, it was popular to be pessimistic around Netflix. And I think right now it was more popular to be bullish on Warner Bros. Discovery. I think because, Michael Burry owns it, which I forgot to mention. Michael Burry no longer owns Warner Bros. Discovery. He sold everything. I might do a video on that as well. But yeah, I'm excited to see what happens. And of course, if the opportunity presents itself, I change my mind. I buy some. I buy heavy on Warner Bros. Discovery, and we go from there. So with that being said, guys, thank you guys so much for watching, and I will see you guys on the next one. Bye.